Okay, so here's my attempt to value a SaaS company using a discounted cash flow model. This originally arose because I was trying to make a couple of investment decisions around this point in a company's life cycle where it's got around $200 million of revenue. It's still pretty fast growing. It's still cash flow negative. And I want to understand what is the actual value of the company today, and therefore what enterprise value to revenue multiple should I be willing to pay? Because obviously a lot of these companies have traded up a lot over the past several years as the markets remained hot. There's lots of money chasing yield. There's lots of money that the acquirers have used to make these businesses look really attractive from an investor's perspective at all stages of their life cycle. And because I was actually doing this, I thought it'd be interesting to do sort of like a DCF across all years of a company's life cycle. So starting at year one, when the company does $50,000 revenue, what is this company actually worth? Should you be investing in companies at the early stage? And as it grows into a company that maybe raises a seed round, then raises a Series A, then raises a Series B as it approaches 10 million of ARR, raises those growth rounds, maybe goes public and becomes a public company that eventually will create EBITDA margins and eventually be valued on an EBITDA multiple. So, as a quick walkthrough and some of the kind of key notes that I thought were interesting about this, one is that you're going to see a lot of my personal bias in these numbers. So, for example, probably the biggest driver of value in this equation is the discount rate, which we explained a little bit in the blog post, but essentially, how much do I actually believe that this company will become this company in 20 years? The analogy that I used in the blog post is a gambler. If I give a gambler $5 or $20 today, are they actually going to pay me back a year from now? And how much do I have to get paid back in order to compensate myself for the risk that they're not going to pay me back? And so a company, in my opinion, that has 50K of ARR has a very low likelihood of becoming this $2 billion revenue company, $400 million EBITDA publicly traded company. And therefore, I put a really high discount rate on this because I think that these future cash flows are very, very unlikely to actually happen. And as you can see, this discount rate goes down over time as the company maybe goes from founder sales to getting those first BDRs and AEs up and running, to finding a couple channels that actually work, to realizing that the market is really high, to establishing their leadership in that market, to actually going forward and de-risking the business in order to become a market leader that has lots of scalable go-to-market channels. And so this discount rate goes down a lot, and you're going to see that the value of this company, which is in this NPV line, goes up significantly as this discount rate goes down. And that's one of the interesting things here, is that really the revenue that this company is generating is going to increase the valuation because eventually it's going to lead to cash flows, which is what it's all about in the future. But especially in the early stage of the business, when they can de-risk the business, their NPV goes up considerably because these future cash flows are more and more certain. So this is the revenue multiple that you should be willing to pay at any given point in the business. As you can see, when the business is still growing quickly and it has a low discount rate, it has a very high revenue multiple that you should theoretically be willing to pay. Of course, all these numbers are super fungible. There are companies that continue to grow at 20, 25% forever, it seems like. Look at Salesforce, look at Amazon, look at Facebook, that still grows at 38% a year. Another big driver here is the EBITDA multiple. This is a 20x multiple, which basically implies a 5% EBITDA yield. I'm using EBITDA as sort of a proxy for cash flow, net income, whatever the heck you want to talk about as your valuation driver. This is something that has a tremendous amount of impact on the valuation of these companies. And if you think that the market's going to stay hot, you can pay a 22x revenue multiple. If you think the company is going to continue to grow at really high rates for a really long time, you can pay insane multiples of revenue for these companies. So this is sort of the model, and this is how I think about the world. As you can see, I'm not somebody who's going to be excited about investing at early stage. That's just sort of my bias. I think there's just too much risk here. And then this is where companies start to become really attractive. And if you can pay a lower price than this, then you're doing okay. This is the sort of very simple 5-year entry and exit model for your typical sort of venture investor, how they think about it. It's like, hey, these numbers, by the way, are in millions. Companies doing 10 million of ARR. We're going to invest at a crazy price, but over time, this business is going to continue to grow and it's going to trade at a high multiple at the end. We don't really know why, but we think we're going to be able to sell it or go public, or that's what the comps are, blah, blah, blah. We haven't thought about this in a super robust 20-year time horizon, even though this DCF is admittedly very simplified. But that's just sort of the way that we think about it. There's going to be 3 more rounds. We're going to get 20% diluted the whole way through because we're not going to do a pro rata for whatever reason. And so at the end of the day, we're going to make a bunch of money, and we feel good about that. And therefore, let's do it. Let's just keep doing this thing, which in my opinion is not the most robust way to think about this. So those are some quick thoughts on this model, kind of how I've thought about the value of a SaaS company. And of course, all these numbers in blue can be changed drastically, and that's really what drives the value. And so that's where it becomes really more of an art than a science, and understanding, can business continue to grow? Can they expand their margins? Will somebody pay for this thing either in year 20 when it's a publicly traded company, or maybe it's year 5 because there's really awesome IP here, or whatever the case may be.